Welcome back to the Deep Dive. Today, we're taking a really fascinating look under the hood at Duolingo.
Yeah, the language and, well, education giant now.
Exactly. We've been digging into their Q3 2025 shareholder letter, and honestly, what we found is a company managing just massive, explosive growth, but are also staring down this genuinely complex strategic dilemma.
That dilemma is absolutely key. I mean, the source material, the letter itself, makes it really clear they aren't just chasing quarterly profits.
Right.
They're driven by this, well, singular, pretty audacious mandate. Their core mission, it's stated right up front, develop the best education in the world and make it universally available.
And that mission, it sets the stage perfectly for our deep dive today, doesn't it?
It really does.
Our goal isn't just to, report the incredible numbers they posted, which are, frankly, huge.
Yeah, they are.
But it's to analyze the strategy behind them. We need to figure out, okay, what key metrics signal real lasting scale? And crucially, how is this company balancing those short-term financial demands against this, very long-term, potentially very expensive goal of basically changing global education?
It's a real high-wire act.
Totally.
And maybe we should start with just the immediate validation of their scale before we even get into the strategy weeds.
Good idea.
The single biggest kind of quantitative milestone they hit in Q3 2025, and this really underlines their shift from just a big app to more of a global education platform, was crossing 50 million daily active users.
Wow, 50 million daily.
Yep.
50 million people logging in every single day. That's a huge shift in global habits, isn't it? All driven by one app.
Exactly. So let's maybe unpack that scale a bit, looking at the Q3 2025 performance snapshot, compare it to last year.
Okay.
If you look at those daily active users, the DAUs, they jumped 36% year over year.
36%.
Yeah, from about 37.2 million in Q3 24 up to 50.5 million this quarter.
And the overall reach is just staggering, too. Their monthly active users, MAUs, they grew 20% year over year.
Hitting 135.3 million.
When you have an engaged user base that size, the monetization has to follow, right? Even if it takes a little time.
It definitely is following. And the conversion story is strong, too. They grew their paid subscribers by 34% year over year,
Okay.
reaching 11.5 million. That's a really substantial subscriber base, and it definitely shows the freemium model is working very effectively for them.
Okay, but here's where I want to pause on a nuance. Because even with that massive influx of new users, which you'd think would dilute the paid numbers,
Right.
their paid subscriber penetration, so as a percentage of their trailing 12 months MAUs, still managed to creep up from 8.5% to 9.0%.
And that percentage point is critical. When they say LTM MAUs, that's last 12 months monthly active users.
Right.
It ensures they're measuring against a more stable kind of average user base, not just, a single massive spike in 1 month.
But I have to ask, if they're adding tens of millions of free users, is half a percentage point increase in conversion actually fast enough? It shows they're converting more people, sure.
Yeah.
But the vast majority of that huge new user base, they're still not paying. Does that put pressure on the strategy?
Oh, it absolutely does. And that tension is really central to the whole shareholder letter, which we'll definitely get to.
Okay.
But before the strategy deep dive, the financials, well, they look stellar, at least on the surface. Revenue hit $271.7 million. That's up a massive 41% year over year.
Wow. Mostly from those paid users, presumably.
Largely, yeah. And total bookings were up 33% to $281.9 million. So the top line is growing really robustly.
And their efficiency seems to have improved dramatically, too. Adjusted EBITDA rose to $80.0 million, improving their margin from, 24.7% to 29.5%. Yeah. That shows real operating leverage kicking in.
It really does. It's a picture of, pretty flawless financial health, except for one number that just screams off the page, and it demands clarification, I think, for you, the listener. We're talking about net income, which rocketed from $23.4 million last year to an absolutely eye-watering $292.2 million in Q3 2025.
Whoa. Okay, yeah. That jump.
Yeah.
That's not just regular operating growth, is it?
Not even close. It's simply not sustainable operating growth.
Right. We absolutely need to explain this, because if you just glance at the headline number, you'd think they suddenly became 10 times more profitable overnight.
Exactly.
So what's the crucial footnote? What's the detail explaining that anomaly?
It is entirely down to a one-time non-cash event. The letter notes pretty clearly that $222.7 million of that huge net income figure was a non-recurring income tax benefit.
Okay. Tax benefit.
Specifically, they released the valuation allowance that they previously recorded against their federal and state deferred tax assets.
Okay. Right. So for those of us who don't spend our days deep diving into accounting standards,
Fair enough.
what does releasing the valuation allowance actually mean? Like, in plain English?
Okay, think of it like this. For years, maybe a company racks up losses or certain expenses, right? And these give them future tax credits, basically IOUs from the government,
Okay.
that they can use later to offset profits when they eventually make them. These are called deferred tax assets.
Got it. Future discounts.
Pretty much. But accounting rules, GAAP rules, often require companies to put a valuation allowance. Think of it like a reserve or kind of safety net on those assets.
Why?
It's basically the company saying, well, we might not actually make enough profit in the future to use all these credits.
So they're essentially being skeptical about their own future profitability.
Exactly. Or at least the accounting rules force them to be until they prove otherwise. But now, because of years of sustained profitability and this phenomenal growth.
Like the numbers we just talked about.
Precisely. The company now has enough conviction, enough evidence that they will use up all those tax assets in the pretty near future. So they release the allowance. It's kind of like cleaning out the attic and realizing all those old receipts you filed away are actually worth real money right now.
Okay.
It immediately flows to net income as this massive paper gain. But, and this is key, it's not revenue from selling more subscriptions or ads or anything like that.
That makes perfect sense. Okay, so it's actually great news for their long-term financial structure, signifies confidence,
Definitely.
but it's really important context for understanding their core operating performance this quarter.
Exactly right.
Okay. So now that we've sort of framed that astonishing performance snapshot, let's pivot. Let's get into that strategic high-wire act, because this is where the letter gets really, really interesting.
Yeah, it really does. And it all seems to start with one of their, I think they have 5 core operating principles.
Okay.
One of them is take the long view. The CEO is explicitly saying, look, our opportunity is to teach billions of people across the globe.
Billions.
And they believe, even with 135 million MAUs, that they are still fundamentally in the early stages of this whole journey.
And that perspective, that long view, it dictates how they allocate resources, how they spend their money, right?
Totally. They break down their product improvement efforts into 3 core areas. And they've actually ranked them, interestingly, based on how quickly they think they'll hit the balance sheet.
Okay, what are the 3?
All right, number 1 is monetization efforts. These have the most immediate financial impact. Think, adjusting pricing, improving the subscription flows, that kind of stuff.
Makes sense. Quickest path to revenue.
Exactly. Second is user growth. This takes longer, right? Because new users, they need time to actually bond with the product, get hooked before they convert into paying subscribers.
Right, there's a lag. And the third, which sounds like maybe the hardest.
Teaching better.
Teaching better, okay.
Absolutely. And this, they say, takes the longest time to show up financially because first it has to actually improve user engagement, improve the educational quality, which then improves the user growth rate, which finally, down the line, improves monetization.
Wow. Okay, so it's like the furthest removed lever from the money part.
Correct. But potentially the most powerful differentiator in the long run.
Which brings us right back to that strategic dilemma, that tension. The CEO talks about navigating trade-offs.
Yeah.
Like finding that delicate balance where maybe a feature designed to boost immediate subscriptions might actually annoy free users or slow down that long-term user growth engine.
And the really interesting strategic pivot in Q3 was precisely about deciding which kind of pain they're willing to accept right now.
Okay.
The company made a very deliberate decision, they state, to shift the balance toward the most long-term initiatives.
How so?
Well, they're explicitly investing proportionally more resources in teaching better. And, this is crucial, they are prioritizing user growth over monetization in the A/B tests they are currently launching.
Wait, hang on. That sounds that sounds pretty aggressive for a public company that's showing stellar revenue growth already.
It is aggressive.
They're intentionally slowing down the optimization process, the very thing that's probably driven a lot of their recent profit growth.
That's what they're saying, yes.
Is there a genuine risk here that they sacrifice, current momentum for some outcome that might be 5, maybe even 10 years away?
The risk is absolutely inherent, which is why this pivot is so revealing about their priorities.
Right.
They seem willing to sacrifice some short-term gains because they believe the long-term payoff is just exponentially higher.
And what's driving that conviction? Is it just faith?
Well, it seems directly tied to their conviction about AI, artificial intelligence.
Ah,
Their stated ultimate goal, the big vision, is to develop an app that is, and I quote, more engaging than and teaches as well as a personal tutor across multiple subjects.
a personal tutor. So like actual one-on-one quality instruction, but from an app.
That's the moonshot.
Why does AI make that goal feel achievable now? Maybe in a way that older ed tech never quite cracked.
Well, because AI seems to be the only tool, really, that allows them to scale true personalization to hundreds of millions, potentially billions of people simultaneously.
Right.
Traditional software, it teaches to the average user, the median. AI, especially with large language models and sophisticated learning algorithms, lets the app adapt the difficulty, the conversational style, the error correction feedback, the pace for every single individual learner.
Real-time adaptation.
Exactly. It allows them to deliver the core value of human tutoring, that real-time adaptive challenge and personal feedback, but without the, frankly, prohibitive cost of hiring billions of human tutors.
Okay.
That seems to be the conviction driving this disproportionate investment in teaching better.
That makes a lot of sense. That's the big strategic picture. Okay, so let's look at what actually fueled the momentum this quarter, because they found success in some maybe unexpected places.
For sure.
We have to talk about chess.
Yeah, chess. It became their fastest growing subject in Q3.
Wild.
And this is significant, not just because, people like chess.
Right. But because it validates that their teaching methodology, their user engagement models, they're actually transferable beyond language learning. It shows the platform itself has broader utility.
That's a huge proof point. And they're building on it, right? Introducing player versus player in Q4.
Which is a massive social layer addition.
Yeah.
That should dramatically increase engagement time, stickiness, all that good stuff.
Definitely makes it stickier.
The other huge anecdote in the letter, it relates to brand momentum, specifically over in Asia.
Okay.
They called the partnership with Luckin Coffee their biggest brand moment in Asia.
Luckin Coffee. How does an education app team up with a massive coffee chain like that?
Well, it was apparently a huge cultural event over there. The partnership involved over 26,000 Luckin stores.
26,000.
Yeah. And they sold more than 10 million Duolingo branded drinks in just 2 weeks.
10 million drinks.
It's less about direct product conversion, obviously, and more about just cementing that brand awareness, that cultural relevance in a really key expansion market.
Wow. It brings Duo the owl and their characters into physical spaces across, an entire continent. That kind of visibility is just priceless.
Absolute priceless. Okay, now, despite all these wins, they did note that user growth was actually slightly slower than in Q2.
Slight deceleration.
And a fascinating part of that slowdown, according to the letter, was kind of self-inflicted. It related to their social media strategy.
Yes. This is such a beautiful little business nuance. They're famous, right, for their extremely distinctive, often viral social media presence.
Yeah. The owl.
The owl. What they call their unhinged content.
Right. The memes, the slightly bizarre stuff.
Exactly. Often bizarre, highly personalized, meme-driven, sometimes, slightly inappropriate content featuring Duo, and it generates massive, massive reach.
Okay, so they noted they initially posted less of that stuff. Why?
To try and prioritize, it sounds like long-term brand sentiment and maybe community feedback. They were trying to be, I guess, a little more grown-up.
Okay. And what happened?
Impressions dropped. And the moment they resumed posting more of that unhinged content, boom, they saw a significant spike in impressions again.
Fascinating.
It really highlights that tension, doesn't it, between maintaining, a responsible corporate image and just capitalizing on the massive, often chaotic reach of internet virality.
Yeah.
They seem to realize that that distinct, recognizable, maybe slightly weird brand voice is a massive, essentially free acquisition tool for them.
They also mentioned a modest increase in just general marketing spend too, right?
Yeah.
To help drive momentum, especially in the U.S.
Yeah, a little boost there. But ultimately, they kind of loop back to the main theme. They recognize that sustained, long-term gains will only come from prioritizing that core product effectiveness, the teaching better strategy.
Gotcha. Which brings us sort of naturally to their immediate product initiatives heading into Q4. What are they focusing on?
Well, they're focused on giving learners more tools, it seems. They've introduced a new flashcards exercise specifically for better word memorization.
Okay, that makes sense. That's often a sticking point in language learning.
Definitely. And they're also focused on boosting adoption of their premium max tier.
Right, the higher priced one.
Yeah. And to do this, they're launching a guided video call format. That feature really moves Max closer to that goal of providing more personalized, almost conversational tutoring.
Interesting. Pushing towards that personal tutor ideal.
Exactly. And smartly, I think, they're working to legitimize the education people are getting on the platform.
How so?
They launched a LinkedIn integration, so learners can now showcase their official Duolingo score directly on their professional profile.
Oh, that's clever. Turns casual learning into something, potentially resume-worthy.
Precisely. Makes it feel more valuable, more tangible.
And then looking towards the end of the year, they've got their big annual events coming up.
Yeah, the two big ones. The year in review, which everyone loves sharing, and the New Year's promotion. Both are global events, and they're clearly designed to maximize user acquisition right when everyone's making New Year's resolutions.
Setting themselves up for a strong start to next year.
Absolutely, but they're trying to maintain that momentum right into January, which is traditionally, peak season for learning apps.
Okay, so this deep dive, it's really shown us a company with just massive scale, right? Confirmed by hitting that 50 million DAU milestone and exceptional financial growth, but growth with a strategic asterisk, maybe.
Yeah, I think that's fair.
The fascinating thing, the duality here, is that deliberate choice. To sacrifice some potential short-term monetization gains in their testing, purely to invest in that harder, much longer-term goal of improving the fundamental educational quality.
That decision really signals conviction, doesn't it? By pouring resources into teaching better, they are betting big. They're betting that the transformative potential of AI, specifically to solve personalized, high-quality tutoring at scale, is real.
So the biggest risk and the biggest reward.
Yeah, it seems tied not just to optimizing conversion rates, but to whether they can fundamentally change what educational software is even capable of doing.
That really feels like the ultimate takeaway from this shareholder letter. Okay, so we'll leave you, the listener, with this final, maybe provocative thought to chew on.
Okay.
Given their proven ability now to expand beyond language, clearly proven by chess, and their stated commitment to finding a product that teaches as well as a personal tutor, what universally needed subject beyond language and chess might represent the next massive educational opportunity for this model?
That's a good one.
Something to think about.